Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. Today I thought I'd pose a question that I was asked a few weeks back regarding a metric that's commonly used in the commercial real estate space. And that is, what exactly is a cap rate? Now, the way I like to describe a cap rate is that it's a way that investors, a metric that investors use to compare two different investment types. The way that cap rates are calculated is to take the net operating income of an investment, which has to do with the total rents minus the operating expenses, gives you whatever the net operating income is, and then divide that by the value of the property, and you get what's known as your cap rate. So as an example, let's imagine that your net operating income for an investment is $100,000. You would take that $100,000, divide it by, let's say the value of this property is $1 million, so $100,000 divided by $1 million, now you get a 10% cap rate. Now, you may be asking, is that a good cap rate, and what exactly does that mean? Well, it's a simplified version of a rate of return on an investment. So, for example, if you were to invest that $1 million into the building, you could expect $100,000 to be returned to you throughout the course of the year. Therefore, your simplified return would be about 10%. And the reason why investors use cap rates is because it makes it a lot easier to compare two different investments. So for example, if a property is giving you a 5% cap rate and it's worth $1 million, that means you're going to receive about $50,000 a year in income from the building. However, if you look at another property and it gives you it's a 15 cap, then it's going to give you $150,000 in income over the course of the year. Now, generally speaking, when cap rates are higher, generally speaking, there is going to be more risk associated with it. That's because investors, knowing that there's higher risk, are going to want a premium on the money that they have invested in the building. So, for example, in New York City, if you find something like a premium office building close to downtown Manhattan, the cap rate for that building is probably astronomically low. The reason is because it's probably one of the safest investments you can make in this world. It's prime real estate. They're not making any more skyscrapers in downtown Manhattan. Therefore, it's a pretty safe investment for these investors, and there's an opportunity for a lot of appreciation over time. However, if you were to purchase a property in a not so nice area of town with a lot of vacancies and a lot of operational issues within the property, then you as an investor would want a higher cap rate because you know there's a higher risk of you losing your money on the investment. Now, cap rates themselves are not perfect when it comes to essentially projecting your return. Cap rates don't take into consideration the amortization of a property. Generally speaking, with cap rates, they assume that you buy the property outright, meaning you pay 100% cash for it, but in a lot of real estate scenarios, that's not the case. A lot of real estate is purchased using a loan, and over time, that loan gets paid down, which is known as amortization. So that's something you got to factor into your overall rate of return. Along with that, there are tax advantages for owning real estate, which are not factored into the cap rate. And then finally, there's various other components of your internal rate of return, it's called, that is not factored in with the cap rate. So all this to say that using a cap rate is really for investors to compare two different properties. If two different properties are located in a similar area and they have similar metrics, yet one has a higher cap rate than the other, then the one with the higher cap rate is most likely going to be the investment they pursue. So that's kind of a higher level overview of what a cap rate is. If you'd like to learn more about different metrics that are used in the commercial real estate space, I'd be happy to talk to you guys about that. Again, if you're looking to buy, sell, or lease commercial property, I help business owners and investors in the Louisville area do so. So feel free to reach out for a free consultation. I'd be happy to work with you in whatever capacity is available. You can give me a call at 502-536-7315, or you can email me at Raphael, R-A-P-H-A-E-L, at CresantiGroup.com. Along with that, if you like this channel, if you think that you get some value from these videos, feel free to like, share, and subscribe, and be notified of future videos. All right, we'll see you guys next time. Bye.